What is going on, guys? Good afternoon. It's your favorite mortgage lender, Del Kwame, Got Mortgages. I hope you guys are having a blessed week. Hope your holiday week was great. Definitely was much needed. It's always these holidays right in between, right? President's Day, Columbus Day, and stuff like that that we tend to sometimes forget. And we're counting days for trade and different contracts to try to get them squeezed through, and come to realize later on during the fact that oh snap, it's a holiday and we can't actually work. So I'm going to dive right into it for the sake of time and really just go over again, like we usually do, what happened last week. A lot of movement on the interest rate market, right? We saw a lot of different changes on inflation, and actually, inflation in both reports, the CPI report and the producer price index report, both came in a lot higher than anticipated. But the market actually ended up reacting very favorably because there were some key components within the report that actually showed that there is going to be signs of weaknesses, specifically in the PCE report, which we'll get on the 28th, that are we expect that interest rates should drop. In other news, again, the Fed chair did come out and emphasize that the Fed is in no hurry to implement further rate cuts, right? We all know that they took inflation from 9% to now 3%, right? At one point, it was 2.8, 2.9, jumped up a little bit. But they did aggressively, in my opinion, hike for a little while. And then we saw three consecutive back to back cuts in September, November, and December. And here we are, right? We just had the last meeting. They obviously indicated that they were pausing, which was expected. I think in March we will likely see another pause, and then all talks are what's going to happen heading into the spring market, right? So again, what were the different data points that we saw? CPI report, we saw consumer price index. Again, it ticked up on the headline number to 3%. Core stayed right in line at 3.3%. Again, this was anticipated. One of the main driving factors in this, again, those goddamn eggs played a major role as well. Energy, shelter, used vehicles, and motor vehicle insurance. I've been getting a lot of requests for some clients and even some past partners about motor vehicle insurance dropping, and if I have some recommendations. And we've got some phenomenal partners that we work with on the insurance sphere that are really giving some of our clients some awesome quotes and quoting them and saving them a couple bucks, which is great. Now, if we exclude food and energy from that stuff, core CPI rose on 0.4% to about 3.3, which is pretty much in line to where we have kind of been at, right? Now, again, the bottom line, the main persistent component that we're seeing is causing inflation to be really rather volatile has been the shelter component, right? It takes up about 35% of the CPI report, 44% of the core CPI report. So it really makes a major impact when we talk about the market and really just the progress on inflation. Now, again, January shelter reading took a 4.4% year over year increase higher. And remember, that directly impacts rental data. So you've got your apartment.com, realtor.com, Zillow, CoreLogic. Take a little bit of a combination of giving that boost, right? Now, on the other side, the producer price index, which measures wholesale inflation, actually increased by 0.4% in January from December, which was higher than what they were anticipating. And the annual rate held steady at 6.5%. But again, an important component here within the PPI report is that a lot of different measurements within it is set to really drop within the PCE report. That's the Federal Reserve's favorite measure on inflation. And again, although overall PPI was stronger, if we do a deep dive into the report, we'll actually see that there was a lot of significant declines in both healthcare and airline passenger services that are set to drop and show that expectation when we take a look at the producer personal consumption expenditure report on the 28th. Now, again, the Federal Reserve, once again, as I had said, they just had their meeting. We will get some minutes from the past Fed meeting that will actually show, again, some of their further comments of what they're looking to do. But the Fed chair once again acknowledged that inflation has eased significantly over the past 2 years. It remains somewhat elevated, which was expected, but they are in no hurry or no really push to further rate cuts. Which, again, remember, if the Federal Reserve cuts their federal funds rate, that is not a direct correlation to mortgage interest rates. I've had to have that conversation really over the last quarter quite a few times with clients because it actually did quite the opposite where interest rates actually jumped up. If we take a look at as late as August 1st, 2024, because they cut in September. Oops. August 1st, 2024, you can actually see the second the Fed cut, interest rates jumped. And then once again around here, the second the Fed cut, interest rates jumped. And then one more time in December, as we see here, and as we see here in November, it jumped up as well, right? So not necessarily the worst thing in the world when we start seeing that interest rates really kind of staying a little higher for longer and kind of battling within those ceilings, which we're going to talk about later on. So retail sales, this played a major role when interest rates dropped on Thursday and Friday. Not only did we see some really weakness within the producer price index report, but we also saw retail sales drop by almost 1%, 0.9%. They were expecting about a 0.1% forecast, which was awesome. And then we also saw other control groups like auto, gasoline, building material, and food services that are usually excluded dropped by 0.8%. Again, these figures once again show the steepest decrease in 2 years, with spending declines in 9 of the 13 reports. And again, a large major component of this is that they're sharing that almost $1.2 trillion in outstanding credit card debt is currently out there, which is kind of showing that probably people are maxed out on their cards and they just truly have no other financial means to be able to purchase more stuff. Job cuts, again, were fairly minimal. And then we also saw a little bit of a slight decline on the continuing jobless claims with 1.85. It's important to remember, right? People who apply for unemployment have only up to 26 weeks. So just because there's no more additional claims doesn't necessarily mean those people actually went and found the job, right? Now, if we kind of take a look at one thing I wanted to share we got earlier, which was the builder sentiment. And it looks like tariffs are playing a little bit of a role, right? We're on a pretty positive trend. And then February kind of took a little bit of a drop, truly, really, because expectations kind of shown that with tariffs, there's a little bit of an uncertainty. It's a little bit of decline from that standpoint, not the direction that we're looking to be in, right? But again, anticipated with some of the uncertainty with tariffs and what's happening. I think I just read something the other day about or earlier today, President Trump looking to do a 25% tariff. So couple different things that we really need to monitor and take a look at, and be able to take it from there, right? So interest rates. Let's take a look at this, how it has been doing. As you can kind of see, pretty much right in line, right? We're anywhere from well, this was a dark decline. If we cut this out by anywhere from 6.75 to 7.25. So about half a point difference between the two is really where we have been sitting at. And if we look at where we have been this year, pretty flat in terms of anywhere from 7.25 to 7%, right? We keep going a little bit in that downward trend. 1 week doing high, the following week it drops, and now we're kind of on the high note. With, I think, literally towards the end of the month, interest rates will drop really to where we want it to be after the PCE report comes out. But we can kind of see that balance where at the start of the week last week we were at 7.1 and we're back to 7.02. Right, a little bit of a swings. Right, this was not a good day. This is when the consumer price index report came out. Then PPI report came out, dropped it. Then retail sales came out, dropped it. And then we kind of just really reversed a little bit of the course of where we're at, right? Because of the builder sentiment and truly just because of what some of the data that came out today when we take a look at, obviously, optimization, right, with tariffs, right? So again, super important week. Also, we're going to get just some mortgage applications, housing starts, permits, existing home sales. Not a lot of big market movement, but we are going to get the Fed minutes, and that is usually a major component when we take a look at how interest rates will transpire. Appreciate you guys jumping on, as always, and I'll catch you guys next time.